When you talk about some of the limitations of traditional retirement accounts like a 401k, or I would assume a 403b, though I've never had one, where the options are very limited. The Roth IRA opens up your options and allows for a lot of different types of investments like stocks and ETFs.
Welcome to the Teacher Money Show, the podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Shaun Morgan, a full-time teacher. That's right, I teach every day just like you, and personal financial coach. And I'm here to help every teacher, whether you're a seasoned teacher looking for fresh insights or a new teacher navigating your first paycheck, to have a richer wallet, classroom, and life.
The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional.
I'm super excited to talk to Andrew Sather today, all about investing basics for your retirement. As the other half of the Investing for Beginners podcast and the mind behind Value Spotlight, Andrew thrives on guiding individuals towards their financial aspirations. His encouragement is contagious, making the journey towards achieving financial goals through investing an exhilarating one. I want to dive right in. The two options people often think of are the Roth IRA and the taxable account for investing for your retirement. Can you tell us exactly what these mean? Like, what's the difference comparing a Roth IRA to a 403b, which teachers are generally familiar with, and a taxable brokerage account?
Yeah, those are great questions. So I like to look at them like a bank account. I could go today and go open a Bank of America account, JP Morgan Chase account, Wells Fargo account, and there's no penalty for that. So some of these investment accounts are the same way. The taxable brokerage account you can go open at Schwab or Fidelity, and it allows you to buy investments, common ones like stocks and ETFs, which have good risk return profiles if you're investing for the long term. So the Roth IRA is just like a taxable brokerage account. You can buy stocks, ETFs, and the only difference is in the name and then the way it is taxed. If you're doing a Roth IRA, you're going to get tax-free growth. And like I said, it's a huge benefit come retirement time.
So when you have the Roth, you put money in and it's already been taxed and you get that tax-free growth. But then with the taxable account, you're putting money in that's already been taxed, but then it will get taxed as it grows. So what's the advantage of having a taxable brokerage account?
I guess the advantage is if you're an overachiever and you've maxed out all your retirement benefits and you're wanting to save and invest in addition to that, then the taxable brokerage account, there's no limit. Just like we can grow our checking account to theoretically infinity. Same with a taxable brokerage account.
So is there any situation that you can think of where someone who hasn't maxed out a Roth IRA would need to invest in a taxable brokerage account? Or would you say, in general, 99% of the time, you're going to be maxing out your retirement accounts before you go with the taxable brokerage account?
Well, that's also a very good question. So something my co-host Dave and I like to say on our podcast is it depends. So if we're talking about maybe you're saving and investing and you want to use the money in 20 years, then you would not want to put it in a retirement account because you take penalties if you withdraw it before retirement. It's kind of a tricky thing because if you start to blur the lines between having a long-term mindset and pulling the money out early, you can get into trouble because of the way that stocks and ETFs work over the long term. But yeah, if we're talking about maybe I want to retire at 45 or 50 or something and you want to have money saved for that, a taxable brokerage account can be a good way to help you achieve that goal.
Awesome. Yeah, so there's an added layer of flexibility. And I want to remind teachers, if you're working for a state, system, the 457B plan allows you to invest money and pull it out once you've separated service without penalty. So if you're no longer working for that employer, you can pull it out. So you still get tax benefits and you get the flexibility. So just keep that in mind, that the taxable brokerage account is a great flexibility tool for people who don't have a 457. But if you have access to that, it basically can act with the same flexibility and have tax advantages for you. So that's just something else to keep in mind that's unique to teachers specifically. Well, I opened up a Roth IRA with Fidelity, and I guess I wasn't paying attention or something when I opened it up, but they told me I can't decide what happens in my Roth IRA, that they were going to make all the decisions. I've since opened up a different one and closed that one and transferred everything to one where I get to make more decisions. But um, is there like a range of how much control you have in a Roth IRA, or is there some things you can't do with a Roth IRA that you could do outside of a Roth IRA? I just know that once you're in those tax deferred accounts, that there can be some layer of you're not allowed to touch it. So can you talk to that?
Well, what makes it fun is the rules and the options are changing all the time, right? So it really is on a case by case basis. I've opened Roth IRAs with Ally and with Fidelity, and I also have a Roth IRA with Merrill Edge. And so some of that was like rolling over from a previous employer. Some of it I just kind of opened online. Each of those have allowed me to buy stocks and ETFs. And when you talk about some of the limitations of traditional retirement accounts like a 401k, or I would assume a 403b, though I've never had one, where the options are very limited, the Roth IRA opens up your options and allows for a lot of different types of investments like stocks and ETFs. All the three that I've encountered offer that, and most will, if you open it online, offer that option, the stocks and the ETFs. And what that does is it gives you a chance to make higher returns. And uh, with investing, there's no such thing as a free lunch. So you can go for I put in air quotes, safest option. If it's not making you any money, how appealing is that? And on the other side of the spectrum, you could try to swing for the fences, but also have huge risk involved. So somewhere within that spectrum, there's usually a sweet spot for people between risk tolerance and what kind of returns they're trying to get. And so some of these Roth IRA options, depending on what your employer is offering you, can give you better returns either because of lower fees or just the returns themselves turning out better because of different selection.
Okay, so you just need to be mindful of that when you're choosing the provider and the options that are going to be available to you.
Yeah, I would go with Fidelity or Ally or Merrill Edge if you're just looking to open up a traditional, that's not the right word, but a vanilla Roth IRA. I would just go with one of those three. They're very reputable.
A traditional Roth IRA is kind of an oxymoron, so we got to keep them.
Sorry.
This traditional account, Roth accounts, just a regular old is what we're talking about here, right?
Yes, yes.
So you mentioned your risk tolerance. As a teacher is trying to figure this out, and I really think that this is important to note that the majority of teachers have a pension, right, which is not usual. And a lot of them have a pension on top of Social Security. And I mean, there's some balancing going on there, but it's pretty, robust pension-wise. Are there any considerations they should have when they're approaching asset allocation, diversification, handling that risk? Well, what are your thoughts on that?
Are you talking on like if we're going down this path of having a Roth IRA?
Yeah.
I like to build a portfolio. So for me, I'm kind of on the other side where 95% of my liquid net worth is all in stocks that I'm recommending for my subscribers. And I don't have, outside of Social Security, I don't have any sort of other safety net that I will have available to me. So I want to make sure that my nest egg, my retirement money, is shielded from any sort of disaster. So that's where diversification comes into play. And we really saw the impact of that during the pandemic, where in an instant, entire industries' fortunes can completely reverse. And that's not the first time we've seen this throughout human history. There have always been these adverse, unexpected, uncertain situations. And so if you don't have your investments diversified, then you might have really bad results based on something that's completely out of your control. But when you diversify, you spread out your investments over different options, then if one bucket falls, the other one is still there to support you. And that's why when I look at investing in my Roth IRA, I'm looking to be diversified. And I think it's good practice for all investors. Even if you have Social Security to fall back on or a pension to fall back on, the money that you are managing yourself, you still want that to be diversified because money is money, right? And so um, I I would be sad to see somebody who goes through all the effort and the work and the savings discipline to open their own thing and not be diversified and have nothing to show for it. I think that would be a disaster. Diversification is one of those things that we can all do, and it can help ensure our positive results over the future. And so I think it's something to keep in mind, regardless of your financial situation.
Okay, so I want to make sure that the listeners are understanding what we mean by when we say diversify. Does this mean invest in Walmart, Apple, and Amazon? Now you have 3 stocks, you're diversified. Does it mean you have to put stocks and bonds? Does it mean you need to have something else like crypto in there? Like what does diversification actually mean? I mean, I'm sure it's different from person to person. It depends, like you said, but can you talk more to what we mean when we say diversify?
Yeah, I would say you can diversify in all those ways, and finance can be overwhelming because there's just the endless barrage of options. A lot of people, like if you're in a 401k, for example, a lot of people's 401ks are invested in these mutual funds or these index funds. And what those funds are doing is they're buying huge swaths of the market. So the S&P 500 index is a good example of this. 500 of some of the biggest and best businesses in the world all put into an index, very heavily US weighted, but they're all put into this basket. And then in your 401k, you have this index fund that you own. And so as the market, the stock market, goes up in value over the long run, you get exposure to that. And because it's spread out over 500 stocks, if Amazon were to go away tomorrow, which is highly unlikely, but if it were to happen, one stock's down 499 can still carry you forward. So because a lot of people's 401ks tend to be in stocks, I like to think of diversifying in that way. Some people have a preference for real estate. Some people might have a inkling towards crypto. I don't see anything wrong with any of those things per se. But for me, looking at the history of different financial assets, the stock market has been the better one over a longer time period that has been safe and steady. And I'm not talking about short-term swings. I'm talking about over the very long term as the economy has grown. So to me, I think stocks is a good place to really have diversification. And if you want to diversify outside of that, that's cool too. But if you're really looking for high risk adjusted returns and you're in the building stage of your wealth, the stock market it's hard to beat the stock market.
All right. So you mentioned mutual funds, index funds, and you kind of explained those. You've also mentioned ETFs a couple of times. Can you explain how that might be different and why those are an important part of investing?
Yeah, I like to think of ETFs as, again, kind of like a basket of different things, a basket of different stocks. They have all these flavors now. Like, I mean, an ice cream shop would be ashamed that they don't have as many flavors as we have ETFs today. But the most common ones, and I think the easiest one for people to buy, is something like SPY. That's the ticker symbol SPY, or ticker symbol VTI. And either of those you can buy, and you automatically get all the diversification we just talked about. All you have to do is type that one ticker into your brokerage account, and buy it, and you are invested in the market. And that's such a nice thing, like the convenience of that we can open an account online, put an automatic deposit into something like a SPY, and not do anything else, is such a frictionless option that was not available for many years. And so that's a great way to do it if you're not interested in picking individual stocks. And I would say for most people, they should probably just hit that easy button and just buy an S&P 500 index like ticker SPY and be done with it. Now, saying all that, there's all these other options if you want to, you could do an airlines ETF, you could do technology ETF. There's all these different flavors. And so if you enjoy trying to optimize your finances, that can be a fun way to go. But again, for the majority of people, an index ETF is a great way to go. And it has benefits over a mutual fund because the fee structure is so much lower. And so the fees, you hear like a percent here, a percent there, doesn't sound like much. But over a lifetime of somebody saving and investing, saving on fees can make a huge snowball impact on your retirement. So that's another benefit of the ETF that has given it's like the next evolution of the mutual fund. And it gives you a very passive, low effort, low cost way to invest in the market and grow your retirement savings without having to do much.
That's a great explanation. I love that. And if someone wanted to know more about these like other options, right, besides just the easy button, is that what you talk about on your show? Do you talk about these, deeper dive things into what people need to think about when they're investing?
Yeah, that's what our show has evolved into. We take a lot of listener questions and we try to answer as many of those as we can just on the air on the show. And so because there's a million ways to do that, we've answered a million different questions, it seems. And that's a great place if you're looking for dip your toes into some of that more complicated stuff. You could go to our show and ask a question.
Awesome. So if you want to, find the link to Andrew's show, you'll be able to find it on our show notes. You can go to teachyourmoneyshow.com/podcast, and I'll have a link to Andrew's show there. You can dive really deep in there if you want to, or you can just click the easy button. Like you said, it's up to you, whichever you're most appealed to. Like if you want to spend the time listening and gathering the information and optimizing, and that's fun for you, and you think it's going to be beneficial for your, your finances, go that route. If that doesn't sound like something that's interesting to you, hit the easy button. So if you want to check it out, like I said, teachyourmoneyshow.com/podcast. I'll send you that way. So you talked about investing for the long haul and having the fees low and having just something that's going to be diversified over that whole time. But then when you're in the middle of this slog, a pandemic hits or a recession hits or something crazy happens in China, and whatever happens, the stock market takes a dip and people start freaking out. How can you stay disciplined during this whole time and avoid making emotional decisions when investing in like in a Roth or a taxable account going forward?
I'm kind of a financial history nerd. I love looking at the history of finance, and I really don't know if there's any other way to feel comfortable with the long-term results of the stock market until you understand the history and the basics of the market. And so if we were to take a stock market chart and look at how that price moves, like you said, there are times all of the time, 2020, 2016, 2009, 2000, times where the market takes a deep crash and people get wiped out and you have headlines and all this negativity in the market. But if you zoom that price chart out and you look over long time periods, decades, 40 years, 60 years, 100 years, that roller coaster of a stock chart turns into this it looks very smooth and up and to the right, because the stock market is all it is. It can be very complex, but all it is it's just a place where ownership of businesses trade. So when I buy the stock market or I buy a stock, I get a piece of ownership. If I buy a share of Apple, I am partially owning Apple, the company. And so because the economy, the US economy, has grown for years and years and years, the businesses inside that economy become more valuable. And so that's why when you zoom out and you look at the chart of the market, it follows the growth of the economy, because the economy is made of businesses. Businesses are made of people. People are generally ambitious and wanting to better themselves in their life, and innovating and hardworking and all of those things lead to growth in the economy, which leads to growth in the stock market. And so we have to understand that yes, over the long term, the market will grow and generate significant wealth, but also there are time periods where things that are unexpected happen and the market crashes and people panic. And again, that's because the stock market is made of businesses, and businesses are made of people, and people are the investors, and we all are emotional as well. So understanding that and keeping your money in for the long haul will help you to participate in the growth of the economy without having the detrimental effects of the stock market if you have this long-term mindset and you are in it for the long term.
Awesome. I I love your explanation of an index, and I think that really helps with this idea. You have this basket of stocks, and people freak out because stocks go down in price. They're like, oh no, I need to sell because I'm going to lose everything. It's unintuitively actually a good thing when stocks go down in an index, because that means that this company is no longer performing well enough to be in the index, and eventually they'll disappear, and a well-performing company will jump onto that index. So it's not the time to freak out. It's the time to buy, because the good companies that are still there are inexpensive, and they'll go back up in value, like you were saying. And you know what? If all of the companies in America stop going up in value and they tank, you have a lot more problems than your retirement account. This country is in a big trouble if all businesses in America disappear. So, it's either going to be amazing because it's going to grow, or we're in a lot more trouble than worrying about our retirement accounts anyway. So it's going to be best to just stay the course, stay for the long haul, and keep your emotions out of it, because the emotions don't matter to your money. The money is just going to do what it's going to do regardless of how you feel about it. So just let it ride. Let it ride.
Yeah, super well said. I like that way of thinking of the market is really a well-oiled machine, and the winners do lift up some of the losers and make up for the losers. So it's really a cool thing for our money.
Yeah. All right, so we've talked about listening to your show. Are there any other tools or resources you recommend for teachers who want to learn more about investing in either the Roth IRA or in a taxable brokerage account?
So a book I came across at a conference that you and I may or may not have met at is a book called The Richest Person in Babylon. And I like that. Although it's not directly about investing, it talks about the importance of setting aside money for yourself when you earn it. And so, you could be the all-time greatest investor in the world, but if you don't have any money to invest, that skill doesn't do anything for you. So one of the best things that most people can do for their retirement is to put as much money as they can as early as they can, and finding tools like that is a good one. Another tool that we've created recently is called Financial Birds and Bees, and that one kind of like some of us may have gotten the birds and the bees talk, but not a lot of us maybe got that talk for finance. And so that's what we've tried to come up with, is something that's easily accessible and digestible, that can give you more, like give you that next step of understanding what are my options for investing and what are some gaps I can kind of fill in and get myself further down that path of pursuing investing and financial freedom. So you can find that at financialbirdsbees.com, and hopefully, either of those resources would help somebody take that next step.
Yeah, that's awesome. Thank you for sharing those. When you said the richest person in Babylon, which for those that might be like, no, it's the richest man in Babylon. This is an updated, revised version of that book for a modern audience. So you can check out that version. And I'll once again link to that teachmoney.show.com/podcast. But you're pointing out like you need to have money to invest your money, right? So really, the first step is, as an old SNL skit said, don't buy stuff you can't afford, right?
Yeah. Oh, yeah.
You need to have your money saved. You need to have money set aside so you can invest your money and do that as early and often as possible. I've got two more questions for you that I ask all of my guests. The first one is, what is your number one tip for teachers to have a richer wallet, classroom, and life?
Ooh, that's good. Yeah. Can I split that up into two parts?
Sure. Go
Okay.
for it.
So I would say the first part is our tagline for our show is your path to financial freedom. And I think obviously for everyone that means something different, but I truly believe that the feelings of financial freedom can happen a lot sooner than most people think. So you have people who are, in survival mode, maybe drowning, and that's something different. But if you get to a point in your life where you can save and invest and put money away, you might be closer to financial freedom than you think. One of the things about getting rich, becoming somebody who's rich, thinks they're rich, has the dollars to show that they're rich, is they can get really caught up in their pursuits, and it can really be a never-ending treadmill, and that stuff fades away. So I would say don't discount your ability to feel financial freedom just because you don't think you're rich or you don't think you have the dollars to feel rich. And then the second part of that kind of fits in with the first part, but basically to have this mindset that you are a steward of the money instead of somebody who's just trying to enjoy the money. And for some weird reason, having a stewardship mindset really changes the way you behave. And for a lot of cases, it improves your results because you are treating money differently. So that's something we try to teach in Financial Birds Bees is if you have a stewardship mindset, you start to approach money as like you're managing it instead of being very emotional with it and looking for ways it can serve you. And so when you are a manager of your money, you can make logical, not emotional driven decisions, and that can really impact your wealth. Again, like my favorite phrase for today, over the long term.
I love it. I've never thought about it in the stewardship model, and I think that's so beautiful. Anyone's thinking like, what do you mean, like an airplane steward? No, it's like a steward is someone who is put in charge instead of like a king. Like the king leaves and he appoints a steward to manage his country, and when that king comes back, that steward's going to give an accounting of how well they did. So they want to make sure they managed that kingdom very, very well. So if we think of it that way, that our money is something that we are a steward over, but not the lord over, that the money's going to serve just us all the time, that can be a powerful reframing of your relationship with money.
Well, I can't take credit for the idea. One of the guys on our team for Birds Bees, Chris Granger, he's the one who's really pushed that idea forward. And for all the reasons you said, it can be super, super powerful. It's just nobody thinks to do it and nobody really teaches it right now. Very few people teach it. And so it's like, what do you mean that this can work? But it can work. We've seen it work. It's worked for us, and I think it can work for a lot of people.
Awesome. Well, thank you so much for sharing all these wonderful ideas about investing. Thank you for coming on the show. My last question for you is, how can teachers get in contact with you?
Well, you can go to the newsletter at einvestingforbeginners.com. If you just send us an email through there, I read every single one of those. You can also listen to our show, the Investing for Beginners podcast, Your Path to Financial Freedom. And that's really the two best places right now. So.
All right. Awesome. Thank you for coming on the show, Andrew. It's been a lot of fun.
If you'd like to come on the podcast for coaching, to share an expert opinion, or just to talk about a topic you think is relevant, I'd love to talk to you. Just fill out the form at teachermoneyshow.com/guest. I look forward to talking with you.